Hello, hello, Khushbu. Very sorry for the technical glitches. So, we'll be restarting this webinar. So, a very good morning to everyone and welcome to this webinar. Earlier, we had done a webinar on Coal India and Map My India. In today's webinar, we will be discussing about Iron Exchange India Limited. We had issued a stock update report on the company on 6th of March. So, this webinar is on that report. So, Iron Exchange India Limited is a pioneer in water treatment in India, having a strong international presence. With a legacy spanning over 59 years, Iron Exchange offers total water and environment management solutions with sales, production, and service footprints across the world. It is a one-stop water and not non-water treatment solution company cat- catering to different industries, institutions, municipals, rural, and urban areas. The company is also engaged in the manufacture of ion exchange resins, which are widely used in different separation, purification, and decontamination processes of water. The most common examples of resins are water softening and water purification. It also manufactures specialty chemicals for water and wastewater treatment, as well as non-water application. Over the years, the company has filed over 50 patents, which is to their credit, and it has launched more than 100 products. The company has a presence across major cities in India with a dealer network of over 100. It also has a global presence. Its products are exported across the world, and exports account for 29% of the company's revenues in FY22. The revenues of the company is through three major verticals. The first and the biggest vertical is the engineering division. Under the engineering division, the company designs, engineers, manufactures, and sells medium and large size equipment for water and wastewater treatment plants, including recycling and zero liquid discharge plants. The engineering division accounted for 58% of the company's revenues in FY22 and had an outstanding order book of around 2,900 crores. The next vertical is the chemical division. Under this vertical, the company is engaged in the manufacturing of water treatment chemicals, ion exchange resins, and other specialty chemicals. The chemical segment contributed to 34% of the company's revenues in FY22. The third vertical is the consumer products vertical. Its consumer products are sold under the Zero B brand. Ion Exchange is the pioneer in the revolutionary reverse osmosis technology in India. The consumer product segment contributed to 8% of its revenues in FY22. The shareholding pattern as of 31st of December, the promoters held a 27% stake in the company, institutions held 12%, and non-institutions accounted for 61% of the company's stake. So let's have a brief look at the recent results of the company. The company recorded a revenue of 512 crores in Q3 FY23, which was a growth of around 32% YOY and 14% growth sequentially. The revenues from the engineering division expanded by 50% on higher execution of orders. The chemicals and consumer products revenues grew by 3% and 30% respectively. The EBITDA of the company increased by 46% while year over year and 17% sequentially to rupees 62 crores, whereas the EBITDA margin expanded by 120 basis points to 12.2% on higher operating leverage. The company has sufficient spare capacity, and whenever the execution is higher, we can see its EBITDA and PAT margin increasing significantly. Similarly, the PAT grew by 70% to rupees 48 crores, while PAT margins witnessed an expansion of around 200 basis points to 9.4%. Its order backlog at the end of the quarter stood at around rupees 2,900 crores. So, what are the key rationale for investment in this company? So, the company has a bid pipeline of around 8,400 crores, of which 25 to 30% is export orders. As a thumb rule, the company is able to convert around 20% of its bid pipeline into firm orders. So we can expect around 1,600 to 1,700 crore of orders to flow from this bid pipeline. The outstanding order book as of Q3 stood at 2,900 crores, giving a visibility of 2 to 3 years. And post the end of the quarter, the company bagged an order of 726 crores from Indian Oil Corporation in February of to 2023 for a water treatment plant, taking its order book to around 3,650 crores. So the company is also undertaking a greenfield expansion for resins. The total capex for this expansion would be around 200 to 250 crores. The company has still not received the environment clearance for this expansion. The company was expecting to receive it in Q3, which has got delayed to Q4. And post this, if the company is able to receive it by the end of the quarter, the production is expected to start from the middle of FY25. Now, chemicals is the highest margin earning, having the highest margin potential for the company. It contributed to around more than half of its EBIT margin, while the revenues from the division was around 33%. The company has strong growth opportunities in a ZLE system. ZLE system is basically a zero liquid discharge system, wherein the water discharge is minimized. So the government is looking to improve the water bodies of the country, and it has uh, it has ordered a wide range of industries to migrate to ZLE treatment techniques. It has legislated industries ranging from fertilizers, brick, coffee, textile, to sugar, paper, paint, and power plants to implement ZLE system for their discharge. It has recently won two orders from Indian Oil Corporation, which includes the use of ZLE system. Now, look, coming to the industry, water treatment industry in India, the Indian wastewater treatment solution is expected to grow at a CAGR of 9% from FY21 to FY31. So, even on a conservative basis, this will give a 9% growth to the company. And further upside is from the treatment of sewage generated in India. Currently, only around 28% of the sewage generated is treated and then released in the water bodies. So there is a lot of headroom for growth in sewage treatment as the government is looking to improve the sanitation and the water bodies in the country. So we expect the revenue, EBITDA, and PAT of iron exchange to grow by 17, 15, and 14% respectively over FY22 to FY25, led by increased execution of orders. The key concerns for the company are the operations of the company are working capital intensive. Although the company receives mobilization advance from its customers, the credit period is high and the receivable days are around 110 days. It is susceptible to the economic cycles. In a down cycle, the order flow up to the company reduces. Since around 30% of the revenues are from exports, the company is exposed to foreign exchange volatility. A lot of projects coming to the company are from government or government-owned entities, and Any delays in implementation of the government initiatives would reduce the order flow to the company. The company had a large project in Sri Lanka. So although the project is guaranteed by Exim Bank, we could see some delays in getting the payment from the Sri Lankan government as it is facing a financial crisis. The company has a low dividend payout, so investors looking for a higher dividend. So the payout is just 10% of the profits. So we believe the investors can buy the stock in rupees 3,000 to 3,480 range and add on this to rupees 3,000 to 3,050 band for a base case value of rupees 3,770 and bull case fair value of rupees 4,020. The stock is currently trading just below our buying range. So that's all about the stock. If anybody has any questions, so they can write it in the box or they can mail it across to me and they would be addressed. So I think there are no questions currently. So if anybody has any query on the company or any question, so they can mail it across to me. I'm Atul Karwa, Fundamental Research Analyst. Currently, the company is trading just below our buying range. I think so. It's around 3,380. It's trading at. All right, then. Thank you, everyone. Thank you for attending this webinar.